What's up, everybody? It's been a rocky start to the year for the stock market, and in my personal portfolio, we have seen a swing from around $81,700 all the way down to $77,200, and now back up to just over $80,000. So it's been about a $4,000 to $5,000 swing in the account in the last few days since the beginning of the year. So today we're going to be talking about what's been happening and exactly what you need to know about the market right now, and I'll just give you a general update on my personal portfolio. If you're new here, my name is Sheldon, and I've been investing for a little over 5 years now, and I make completely transparent videos talking about how I invest in the stock market. So if you're interested in learning about the market and you want to know how to build and grow your own portfolio, then subscribe to the channel, because that's what we talk about here, and let's build our portfolios together. So let's dive right into it, and let's try to understand what's been going on around here, and let's start with the S&P. So the S&P did spike, I believe, to around over 6,000 at the beginning of the year, and then fell all the way down to about 5,800, and now it's back up to today. It actually hit over 6,000 again. So it's been jumping around a lot. If we look at companies like Palantir since the beginning of the year, let's just make sure this chart is refreshed. So it's down 5.53% since the beginning of the year. Nvidia, if we go year to date, also about, or I guess it's up now on a year to date. That's not bad. It is off its highs though by about, so it's, I believe its 52-week high was 53. So it's a little bit under $20 off its highs. Apple has not had the best start, down 8% year to date, and that's a pretty big move for a size of a company of Apple. Like, you'd expect an 8% decline in maybe a Palantir or something, but Apple, that's a pretty big company. Meta since the beginning of the year has actually popped a little bit, and it's back to over 613 a share. So the market's been a little bit all over the place. Big tech did take a bit of a hit there for a little while, but the market has started to bounce back. And if we look at the volatility index, this might be new for some of you guys if you haven't seen or heard of the volatility index before. Basically, it just tracks the volatility of the market. So you can see on a year-to-date chart, it started to spike a little bit as a lot of the big tech stocks were crashing. So typically when volatility is high, even in the positive or negative direction of the market, the volatility index spikes. So in the last few days, it's calmed down a little bit. It's cooled off as things have kind of started to see a little bit of a run back to the positive again. So it's been an interesting year so far. You know, we do have Mr. Trump coming into office next week, and I don't know what dark corner of the internet I found Cheeto Trump in, but I thought it was really funny, and you guys, I decided to show you guys. You're welcome. I don't even know what the cartoon actually says or what it means or whatever. I thought Cheeto Trump was kind of funny. Okay, so there's Cheeto Trump, and he's coming into office next week. So there's been a little bit of uncertainty around that, right? Like, I think typically the general outlook for his administration is typically positive when it comes to the stock market and earnings growth. But there is a little bit of uncertainty there. You know, who really knows what's going to happen inside the first week and inside the first month. So we're going to have to wait and see how that plays out. But it's definitely going to be interesting next week to see how that is reflected in the stock market. So basically, we did go through a little bit of a pullback, right? Like in my personal portfolio, we went from 81,000 to 77. And I'm sure a lot of you guys experienced this as well within your portfolios. So, you know, it's times like that we're actually tested as investors, and when we have to, you know, kind of try to remove the emotion, because I know the feeling. I know what you were probably feeling. You might have been, I should have been selling my stocks near the end of December. You know, you feel like you're going to be making mistakes when your portfolio is going down and you see big red days, and it sucks to see those days, but honestly, just close your portfolio. That's what I did. I didn't even really look that much at my portfolio over, you know, this time here, because the fundamentals of the economy weren't changing. It was just a little bit of a pullback in the market, and it's something that we expected, and it's something that we even talked about here on this channel in the last couple of videos. We said, you know, there's a good chance that stocks could pull back. You know, valuations were getting pretty inflated, so it's something we expected, but I do understand that it's pretty hard in those times to see your portfolio go down. You know, I had a couple days where it was down over $1,000 and then over $1,000, and then You just got to remove yourself from it, to take a step back, look at the fundamentals of the economy, which is what matters because we're long-term investors here. And basically, what does that mean? So what is that? What do I really mean when I say fundamentals? And what I'm referring to is earnings, CPI data, inflation, and so what happened that caused the market to go back up? And guess what? It was earnings, right? On Wednesday of this week, we had JP Morgan and a lot of the big banks start to report, if I can find it here. So JP Morgan, also in the last year, this is kind of random, but look at the chart of JP Morgan, dude. In the last year, the biggest bank in all of America is up 50%. Like that's a crazy gain for a bank. I'm glad I got JP Morgan in in my portfolio. So they came in and reported earnings on Wednesday, I believe it is, and on a 5-day they're up over 6%, which is again pretty stellar for a bank. And I believe it was the 14th or 15th, somewhere in the middle here when it spiked. That's when they reported earnings, and they did come out and they had some good revenue growth and they had good EPS growth. If we look at their financials here, also, by the way, for big banks, like their income statements are a little bit different. So revenue is found a little bit lower here, but is this on? So let's look quarterly because they reported their fourth quarter for 2024. And they had 13.7% revenue growth, which I believe that was actually a couple $2 billion beat. I believe it was like $2 billion over expectations. So that always looks good and helps kind of fuel the economy when big banks come out and beat expectations. So they had 13% revenue growth in terms of EPS. They had 58% EPS growth in that quarter. And this is year over year, by the way, so not quarter over quarter. So it's comparing this $4.81 to this $3.04, not like quarter over quarter. Yeah, that's year over year growth. So that's a big number though. 58% earnings per share for what's the market cap of JP Morgan? $711 billion. So a 58% or EPS growth year over year is huge for any company, but to have a big bank come in, and this kind of is really what kind of started to spark the rebound recently in the market, right? But we also had not just banks come out and report. Obviously, banks did come out and report, and all the other banks seem to do well and have a positive economic outlook. And actually, one thing that I wanted to mention about JP Morgan is what Jamie Dimon said. So if you don't know who Jamie Dimon is, he's somebody that's really good to pay attention to in the stock market. He's kind of like a Jerome Powell from the Federal Reserve. Jamie Dimon is the CEO of JP Morgan. So if we look, I believe profile CEO, JP Morgan CEO James Dimon. But he came out, he's somebody that's important to understand what he's saying. He's a really big, not really political, but I don't know, just somebody that has a big voice in the stock market, and what he says matters. So it's a good idea to pay attention to what he says. And when JP Morgan reports earnings, he normally comes out and gives some statements. And one thing that he said here when I was looking through a little bit of their earnings, he has a positive outlook. The U.S. economy has been resilient. Unemployment remains relatively low, and consumer spending stayed healthy, including during the holiday season. Businesses are more optimistic about the economy, and they are encouraged by expectations for a more pro-growth agenda and improved collaboration between the government and business. So he's kind of referring to the Trump administration stepping in here and having a good relationship with a lot of the businesses in the economy, which I do see happening, and obviously that's going to be a very positive thing. He also points out, however, two significant risks still remain, and it's pretty common to hear these, but inflationary risks and then geopolitical conditions, which, you're going to read any single financial financial statement and hear CEOs talk about inflationary risks, geopolitical risks. That's not uncommon to hear that. So it's nothing out of the ordinary, basically, from James Dimon. So Jamie Dimon. So I guess that's pretty much what I wanted to cover for JP Morgan. There was also, so a lot of the big banks came out, that helped bounce the economy back. And one other thing came out this week, and that was CPI data. So CPI data is basically, it gets released, and it's just inflationary data. And it's, I can make this a little bit bigger. So it's data that I believe comes out quarterly, and they report the inflation within different sectors of the economy. So it's like the different line items here are food, energy, energy services, electricities, utilities, commodities, vehicles, apparel, medical care, shelter, transportation services, and it just reports the different prices. Basically, it's the consumer price index. It's the different inflation data amongst all of those sectors. And broadly, I believe, and this is what, like, if you're like a high level or like really in-depth economic nerd, you really dive through a lot of these. This is like a 39-page document that gets released. I don't really go through it that much, okay? If I'm being honest, like, there's a lot of data here. And, it's really good data to know. This is what I talk about when I say fundamentals of the economy. And, if I had more time, then I probably would go a bit further into these. But I just look at the high-level summary, basically, of what happens with things like this. And the economy reacted good, or the stock market reacted really good to a lot of the data that they released. So core inflation rate shows 3.2% in December, which is less than expected. So that's good, but it wasn't very much less than expected. It was, I believe expected was 3.3, and it came in at 3.2. So obviously that's not a huge beat, I guess you would call it. If it was earnings and revenue, you'd call that a beat. But that actually does result in billions of dollars in the economy, right? Like you see 0.1% difference versus actual and then expectations, and you might not think that is a very big deal, but that's a pretty big deal, especially in terms of inflationary data, because that is literally the difference of billions of dollars floating around the economy. And this is also the type of data that the Federal Reserve looks at if they are thinking about pumping the brakes on interest rates or accelerating interest rates, because they've been cutting rates lately, right? And so if you see inflation coming down, that's a good sign. That's what you want to see. If inflation started to go up, and if CPI data was reported and inflation comes in higher than expected, then that might be a reversal in the Federal Reserve's economic policy, and then they might come in and start to raise rates again to try to, instead of encouraging spending, they're trying to restrict the economy and try to reduce the amount of spending out there. But right now they're trying to accelerate the economy, and it's coming in right now where inflation data is supporting that decision. So these are the type of things you're going to want to look at in terms of the broader market. And basically just know that the Federal Reserve looks at CPI data to make the decisions on what they want to do with interest rates. So basically there hasn't really been anything that is that out of the ordinary happening in the market right now. Like, I guess Trump is going into office. Cheeto Trump is about to be the head of America. So I guess like that's one thing that doesn't normally happen, right? But so you have that, you have a lot of, we're slowly approaching earnings season. So that is something that's going to be really important. Obviously the banks kicked off earnings season, but if we look at when a lot of these big tech companies are reporting, Palantir is reporting February 13th, and right now it's currently middle of January. So in the next 2 weeks here, we're going to start to really see where the economy actually is, because that's reflected in all of the companies' earnings reports. And a lot of it's like late January, early February. Palantir's February 3rd. NVIDIA is a little bit later in February, I guess. But most of the big tech companies are early. Like Apple's reporting January 30th. Meta is reporting January 29th. Google's reporting January 28th. So end of January is going to be an interesting time in the market, because that's when we're going to really see what's going on. And that is, that's what you're going to want to get ready for as an investor. You want to make sure you're positioned well going into earnings season, and understand where your companies are at, what some of those companies are expecting, and if you think they're going to beat or not, because, you know, if all of these companies start to report negative earnings growth and then inflation data comes in higher than expected, that is something that can fuel or at least begin to fuel something like a stock market crash, right? But we're not seeing that. So in times like when there's pullbacks in the market, that's why you look at the fundamentals of the economy, because you can still be confident, even though the market's going down, that, you know, it's going to do fine. And that's when you would actually look at buying the dip in a lot of companies. You know, you look at the fundamentals. Fundamentals are important. So let's take a look at my personal portfolio, and I'll show you what's been going on since here. We're back up to around just over $80,000. 62% total return, just over 30 grand. You know, not too much has gone on. Like obviously Palantir, when Palantir went down, that was what accounted for a majority of the losses in the account. Like when we went down to 77,000, a lot of that was because Palantir was back at like 64, I think was the low that they reached since the beginning of the year anyway. So, and obviously Palantir is a big position for me. I've got like, almost 10 grand, USD inside that investment. So when when Palantir goes down, that hurts my portfolio a lot. Which is why I'm trying to be well diversified amongst all my other positions. And then VOO is one thing that's, you know, that's just the S&P 500. That was bouncing around a lot as well. So that accounted for a lot of that volatility. Other than that, you know, JP Morgan has had a stellar year. It's kind of just been a silent killer inside my portfolio. Like, it's not one that I really talk about that much on the channel because, let's be honest, it's a bit of a boring company. It's just a big bank. Not a lot of people want to hear me talk about banks. So they'd rather hear just talk about other exciting stocks, and I completely understand. But I have it in my portfolio because it's a stability play. It reflects on the economy, and it's just a really solid bank. You know, I love Jamie Dimon. You know, he's just a really level-headed CEO. He understands the economy very well. And so that's the reason that I hold JP Morgan. You know, it's a little bit of a diversity, stability play for my portfolio because, you know, it basically boosted it back up once it was crashing. Like, not crashing, but once there was a bit of a pullback going on, you know, JP Morgan reported earnings, boom, right back to, you know, and that not only helped my portfolio because I own JP Morgan stock, but it also helped the broader economy, and then everything else started to kind of come back as well. So that is pretty much everything that I wanted to talk about in terms of the economy, in terms of my portfolio here. Unfortunately, I am on the sidelines of the market right now. I got no money that I can contribute into these accounts. I'm in school. I'm not working. I don't make any money from YouTube. So, you know, we're just riding it out until I graduate, and, you know, then we can get a job, and then we can start putting money back in the market. And it would have been a perfect time to put money into the market right there. Like, that's an example of a buy the dip moment where the fundamentals of the economy didn't change, but the market was overreacting to a little bit of selling pressure. And I would have loved to put a little bit of money in because a couple stocks dipped, and it would have been a good time to buy. So anyway, you know, is what it is. Thank you so much for watching. I wish you the best of luck on your investment journey. Peace.